What is price to tangible book? So what is a price to tangible book? According to Investopedia, the price to tangible book value is a valuation ratio expressing the price of a security compared to its hard or tangible book value as reported in the company's balance sheet. The tangible book value is equal to the company's total book value less than the value of any intangible assets. Intangible assets can be such items as patents, intellectual property, and goodwill. The easiest way to think about tangible book value per share is to remember that the number represents the amount of money we investors would receive if the company would stop functioning and liquidate all of its assets at the value it has recorded on its balance sheet. Generally, if a stock trades at a higher multiple of price to tangible book share, it has the potential to leave investors with greater losses per share than companies that trade at a lower ratio. This is because the tangible book value per share should reasonably be considered the lowest price at which the stock should trade. In 2011, Buffett stated in one of his annual letters that he would consider buying back any Berkshire stocks when the company fell below 1.1 times its book value. That indicates that he feels that the company would be undervalued at its share price fell below the book value of its assets. I think that is a great case in point for the above point. Price to tangible book value is a valuable metric, but it is not for every company. Notice above in the explanation of what encompasses the formula, such items as goodwill and intangible assets. The ratio is far better suited to companies that have hard assets such as industrials, banks, insurance companies, and retailers. Price to tangible book is not useful in the tech world, as most of its assets are intellectual property, which is near impossible to value. More on this in a little bit. What is the difference between book value and tangible book value? When thinking of the differences between book value and tangible book value, think of book value as a more broad overview of the value of a company's assets. Where tangible book value is a more focused version of that metric, it strips out items such as goodwill, intangible assets, because these items can't be sold at auction. Book value is thought of as the value of assets, and hard assets are items that you could sell and receive cash for them. A good example would be if you owned a company that publishes books that you write. Let's say as you go along with your company, things are going great, and you write several successful novels, and you print those books as well. The money you pay for the printing presses, ink, paper, and other items for physically printing the books are hard assets, where the ideas, characters, and plots that capture the public's imagination are more intangible. And what if your books suddenly fell out of favor and you had to sell your company to pay off your assets? The hard assets of the printing press, paper, ink, and other items related to the printing would have value at a sale, where your plots, main character, or creative ideas would be much harder to place any value for sale. Price to tangible book value would allow you to place a monetary value on your printing assets, where book value would allow you to place a monetary value on your overall business. Okay, let's look at how we can calculate the price to tangible book value with a few companies. How to calculate tangible book value with real companies. Before we look at a couple of examples, let's outline what the price to tangible book value calculation looks like. The formula for price to tangible book value: P divided by TBV equals current market price divided by tangible book value per share. Let's break that down a little more. Now, the current market price is one we can gather from any financial website, but finding the tangible book value per share will require a little sleuthing on our part. Not hard sleuthing, mind you. We have a choice of looking at the ratio either with annual numbers, or if you want more up-to-date data, you can use the quarterly numbers. I will look at two examples, and we will use both methods to give you an example of how this can work. Okay, let's break apart the tangible book value per share a little. Tangible book value per share equals total shareholders' equity minus preferred stock minus intangible assets divided by shares outstanding. Luckily, this formula concentrates on the balance sheet, so there won't be a lot of digging around other financial statements to find our data. The first company I would like to dissect is Wells Fargo. Wells Fargo currently has a market cap of $100.7 billion and a current market price of $24.58. The first thing we need to do is look at Wells Fargo's balance sheet to find our data. Before we go, let's discuss the intangible assets a moment. Intangible assets are items that have no hard monetary value and not always listed bunched together, so we might need to put on our Sherlock Holmes hat to find. Luckily, Wells Fargo lays it out in the notes section for us what they consider part of the intangible assets. From the balance sheet, we can gather shareholders' equity, $182,718, preferred stock, $21,347. And from the intangible assets notes, we can gather our information to determine what constitutes intangible assets according to Wells Fargo. Total amortized intangible assets, $1,805, MSRs, $8126, goodwill, $26,381, and trademark, $14. If we total all those items up, we get a value of $36,312 for intangible assets. Again, items that are considered intangible are goodwill, amortization, trademarks, MSR, which refers to amortization or fair value assumptions of mortgage loans. In Wells Fargo's case, they are the largest mortgage lender in the U.S., and amortization is an intangible asset. Now that we have determined all the inputs for our formula, let's plug them all in and calculate. Current price, $24.58. Shareholders' equity, $182,718. Preferred stock, $21,347. Intangible assets, $36,312. And shares outstanding, 4135.3. Price to tangible book value equals $24.58 divided by $182,718 minus $21,347 minus $36,312 divided by 4135.3. The price to tangible book value will equal 0.81. Okay, that was pretty cool. Not too hard, hopefully. Let's tackle another, shall we? Next up, Prudential Financial is an insurance company specializing in annuities and retirement products. Prudential currently has a market price of $56.77 and a market cap of $22.42 billion. For Prudential, we will look at the annual numbers to calculate our price to tangible book value. Pulling the annual numbers together, price ending 2019, $93.74, shares outstanding, 410.8, shareholders' equity, $63,115, preferred stock, 0, intangible assets, $36,13, goodwill, $30,13, and amortization, $600. Now we can plug all the numbers into the formula. Price to tangible book value equals 93.94 divided by 63,115 minus 0 minus 3613 divided by 410.8, which gives us a price to tangible book value of 0.65. Okay, I think we're getting the hang of this. Now let's take some of our calculations and do some analysis regarding valuation. Using tangible book value to value companies. Now that we have calculated the price to tangible book of a few companies, let's see how we can put this to use to value a company with this ratio. There are several methods we can use, but one note of caution. Whenever calculating intrinsic value, remember that these are just estimates and we need to do our due diligence along with these calculations to determine if the investment is right for us. The first would be to take a longer view of the historical outlook of the price to tangible book value per share. I would recommend at least 10 quarters to give you a good view of how Prudential has performed. Now that exercise can give us a range of price to tangible book values per share that we can find the median over the last 10 quarters. We can also see the trend upward of the tangible book value over the period and the steady range of pricing. The median of the price to tangible book value over the 10 quarters is 0.795. Now we could take that median range and multiply that by the tangible book value per share that we calculate for the present quarter, which would be $149.56. Intrinsic value equals tangible book value per share times price per tangible book value per share. The intrinsic value equals 149.56 times 0.795, which gives us an intrinsic value of $118.90. That would tell us that the tangible book value of the assets for Prudential would be worth more in the market. The current price of Prudential is $56.77, which would indicate that Prudential is undervalued compared to the tangible book values of its assets. If you want to shortcut the historical median, you could simply take the current tangible book value and multiply it by the price to the tangible book value of the current quarter. For Wells Fargo, that would be current tangible book value per share, $30.24, current price to tangible book value, 0.81. Intrinsic value equals $30.24 times 0.81, which would give us an intrinsic value of $24.49. With Wells Fargo's current market price of $24.50, it appears that the company is fairly priced according to the value of its tangible book value. The other valuation opportunity with multiples is the theory of multiple expansion. For example, in our example of Wells Fargo, that currently has a price to tangible book value of 0.81, and that the median for Wells Fargo is 2.36. Then you could simply multiply the current market price of 2.36 and arrive at what the price would be for Wells Fargo under normal market conditions for the bank. The price of that calculation would be $57.82, which is in the range Wells Fargo was trading at before the coronavirus pandemic hit the world. Using that type of valuation is very simple and is a quick way to see if the company is trading at a discount and might warrant further study. In the case of Wells Fargo, the company has undergone some wounds of its own making, as well as the market taking a beating in regards to financials. All these ideas play in our minds when valuing a company. Both of these valuation techniques are simple and easy to execute, don't require a lot of higher math, and can get you in the ballpark. Always remember when Charlie and Warren like to tell us, it is better to be approximately right than precisely wrong. Valuation is an art and a science and doesn't get caught up in finding that perfect number. Rather, use these tools as a means to an end. It is finding the perfect investment for you and your risk appetite. With that, we wrap up our module on price to tangible book value.